Good day, investors. Today we are looking at another tobacco company. This time it's from the US, Altria. So it's a US tobacco giant with Marlboro as its dominant brand, and it has a steady cash flows like many other or most other tobacco companies, and it's appealing to value investors because of its valuation. Although you have to keep in mind ethical or ESG concerns. It is a strong brand moat, high regulatory barriers to entry, and given its addictive nature of the product, its pricing power is really strong, although that moat might be weakening with smoking declines. Management would be experienced, dividend focused, and buyback focused, so solid for the shareholders. Although they had a misstep with Juul, we'll see about that. On the margin of safety side, I would say they are relatively fairly valued. They have a nice dividend payout policy of around 80% of their adjusted income. It's a reasonable company, not overvalued, so we will see it in more detail. So on the meaning, understanding what the company does and whether its business model makes sense to us. First of all, I think Altria is one of the best, one of the largest and most established tobacco companies in the US. Its best known product is, of course, Marlboro. I try to put the brands here, which holds about 40-45% of the US cigarette market, which we'll see in a couple slides. So beyond cigarettes, Altria has diversified into related sectors, such as Anheuser-Busch. So in the bottom, you can see that they have 8 billion in Anheuser-Busch. And the Kronos Group, which is a Canadian cannabis company. Oh yeah, I didn't say, but I assumed it's obvious. Anheuser-Busch is like a beer business, big, huge beer company. And of course, Jules Labs, though largely written down due to regulatory issues, and we'll see about that. The company's business model revolves around basically generating high margin cash flows from traditional tobacco products, reinvesting profits into shareholder returns, such as buybacks and dividends, and exploring next-gen nicotine and cannabis products. Mainly focusing on the US, which is stable and highly regulated. We will see changes on that for the positive side. Our investors should note also that Altria operates in a socially controversial sin industry, right? So tobacco companies face many ethical scrutiny due to health concerns, additional risks. So many ESG-oriented investors are avoiding it. So especially institutions and insurance companies. I think that's for an individual investor. I think that's a plus because you have less competition pushing up the price of these companies. So if you think about this, Coca-Cola is, I don't remember exactly, but 2025 PE where it trades, let's say this trades around 10. So you can see the valuation proposal between the two. And these kind of businesses are like, they need relatively low assets to produce the huge margin cash flows. So they are really similar. Oh yeah, something that might confuse people, that Altria owns the Marlboro brand in the US through its subsidiary Philip Morris USA. So on the first slide of this presentation, you saw that Philip Morris USA, an Altria company. Yeah. So which is fully owned by Altria Group. And outside of the US, Marlboro is owned by Philip Morris International. So these are two separate companies. For the segment breakdown, I have operating companies income from the Q3 data. So this is 9 months year to date. You can see smokable products top, which is smokable consisting of combustible cigarettes and machine-made large cigars. So this is classic tobacco smoking. Oral tobacco products, you can think about nicotine pouches, any other which are you don't smoke, and then you have the all other category, which is actually not making money for them, which includes the Enjoy, Horizon, Helix. So we'll see about these. These are newer inventions trying to get into the so-called like lower risk or no risk category. So this is the new stuff they want to, but they are making their money out of tobacco, old school tobacco and oral tobacco products. So if you would put them in perspective relative to Philip Morris International or BAT, they are less successful with their alternative products. They are more traditional. They are more like imperial brands from the UK, where they mostly get their money from basic old school tobacco. So this is the regulatory part. So if you listened to BAT's annual report, I think earlier this year, in February this year, they also mentioned this, that the US with the new Trump administration is cracking down on illegal, illicit products in the US. So it's illicit at vape shops, yeah. So border costume. So they are cracking down on illicit, basically substitute products to tobacco products, and especially vapor products and these alternative misery stuff that is coming into the US. BAT is hoping that it's gonna benefit its alternative business, and of course, every tobacco company in the US are hoping that's gonna happen. Let's talk about the Moat. The Moat is huge brand of Marlboro in the US, is basically giving them huge dominance, and it's not just the US, right? So wherever in the world you go, Marlboro is really strong brand. Of course, in the US, it's owned by Altria, and Philip Morris International owns elsewhere. So you have really strong regulatory barriers. Of course, the US tobacco industry is heavily regulated, right? And they are US company, which is paradoxically benefits large players like Altria. Paradoxically, I would put in quotes, right? Because I believe regulation is there to protect the big players against competition. So it's more like a government and corporate power merger, but let's not get too ideological on that. Of course, they have scale and distribution, so Altria's size allows for cost efficiencies and superior distribution across retail and nationwide. Of course, it's an addictive product, so you have the nicotine dependence on consumers, ensures repeat purchase and stable demand and cash flows. They have pricing power, right? Even with declining cigarette volumes, Altria has maintained or increased profits through price hikes. That's all. That's also what BAT and other tobacco companies are doing. That these are really inelastic demand type of products. So if the prices go up by 10%, you have demand fall by only 4%. So they are relatively inelastic demand products, so they can squeeze out more from the people. So that's a strong pricing power. That said, the Moat is slowly eroding as the smoking rate declines and consumer preferences shift toward vaping and reduced risk alternatives. But Altria is still catching up, as mentioned. So it's not, I think, if I would have to just like a top of my head put how these companies are, Philip Morris International probably best in moving away from tobacco, or at least getting a larger chunk of their income from non-tobacco. Then you have BAT. Then you have on the third and fourth place Imperial Brands and Altria. Although if they can offset dropping volumes with increased prices, and I don't know how long maybe there is a plateau they're gonna hit, or hitting younger demographics. We know that tobacco companies are famous for targeting children. We'll see how that changes going forward. Can they just increase their prices to offset volumes? Can Altria just move into alternative products? That's something for the future. So that's one of the risks for the company. And then you can see their Marlboro share of premium growth. They are dominating the US premium market with Marlboro. This is just clear cut. They are basically stagnant at close to 60% of the market share for Marlboro. And for Philip Morris USA retail share growth, you can see they are mid 40% of market share. This is their market. They are playing in the US. They are dominating it. They have the strong brands. They have the strong old school business model. We'll see if they can move away from that or grow that, or maybe they don't even have to be. Maybe the business stays as it is. So far, so good, right? So from the management perspective, you have experienced leadership focused on cash returns, dividends, buybacks. So on the dividend side, can I paint here? Yeah. So the goal is 80% payout of adjusted earnings, and they want to pay out quarterly. And they recently increased buybacks from 1 to 2 billion for the period. So they are doing basically most of their free cash flows just goes out the window paying buybacks, dividends, which is great from the shareholder perspective. Although they have mixed capital allocation history. I will have a slide on Juul after this with the Juul write down. So what you want to see from a company like this is to reward shareholders, don't waste capital on bad projects. If they do something with that capital, right, because they need to innovate or change the business because the world is changing, you want to have return on investment on those, which is adequate. So of course they have a strong dividend culture, going back more than 50 years. And historically they've been paying out 75-80% of adjusted earnings, so they are hitting their goal. Right. Juul misstep, right, and Kronos misstep. These moves show a willingness to innovate from management, but also highlights the risk of stepping outside of their core business. Strategic focus for management is currently to emphasizing a smoke-free future. But as we can see, the number is not really happening for them. Investing in heated tobacco and oral nicotine products like On. We'll see how that works out. So far, not so good. And strong emphasis is still on dividends and buybacks, as we see in these numbers. I think overall management is experienced and conservative and committed to sustaining profitability and income stability. They want to grow their dividends yearly. I think since 2018 to 2024, they have a compounded annual growth rate more than 5% on their dividends, so that's pretty nice. And if you think about management's incentives, so as Charlie Munger said, you get what you incentivize, right? So incentives do work. They focus on adjusted diluted EPS. So EPS is really key here, because what that means, if you have flat earnings, but your outstanding shares are dropping because you are doing buybacks, then you can increase your EPS while your share prices, while your outstanding shares go down. Flat earnings. Adjusted discretionary cash flow. Okay, I like the cash flow part. Operating companies' incomes. Okay. Strategic initiatives, right? So they don't really want to get behind. Of course, you don't want to miss the boat. You don't want to be the only tobacco company in 50 years you go bankrupt in history, basically, because you didn't change. But you want to have these companies change in a profitable manner. So this is the Juul write-down, right? So in 2018, Altria invested in Juul. So the Juul write-down refers to Altria's major loss, basically, in value from its investment in Juul Labs. This was an e-cigarette company once considered the future of nicotine products. So basically the breakdown is that in December 2018, Altria invested almost 13 billion for a 35% stake in Juul Labs. The move was meant to help Altria diversify beyond cigarettes and tap into the fast-growing vaping market, especially as smoking rates were falling. Of course, today they are still falling, and they are doing still great in their traditional tobacco, but that's a separate topic. At the time, Juul was valued around $38 billion, so making it one of the most valuable private startups in the US. What basically went wrong is that soon after the investment, Juul faced massive legal and regulatory and reputational problems, right? So regulatory backlash. So the FDA, the public health groups accused Juul of marketing to minors, sparking investigations, new restrictions on flavored e-cigarette products, and youth vaping epidemic issues, right? So the public and political outrage over teen vaping damaged Juul's brand and led to really strict regulations banning many products. Of course, these also include lawsuits. So Juul became a target for thousands of lawsuits related to youth addiction and health issues, leading to heavy legal costs and settlements. So basically, this sales collapsed, right? So as regulations tightened, the public sentiment turned against Juul's market share, and growth projections basically plummeted. So you valued something at 38 billion, and it turned out to be not even close, right? So between 2019 and 2022, Altria repeatedly impaired the value, so they had huge impairments, write-downs of its Juul stake on its balance sheet. From the original close to $13 billion, the value was eventually written down to almost zero, around 250 by 2022. Right. This means 98% of it is lost. In 2023, Altria exited its investment in Juul entirely, so exchanging its remaining stake for Juul's intellectual property rights in a settlement. The company later acquired Enjoy, right? Another e-cigarette maker for about 2.75, so close to $3 billion, aiming for a fresh start in the vaping space. This time the product was already authorized by the FDA, so that helped them. So it was a costly misstep, showing the risks of diversification outside of the core tobacco business and the different dynamics. Right. You can see there free cash flow is growing relatively slow. It's around a bit less than 1% compounded annual growth rate if you compare the 2018 number to the 2024 number. And they are stable with their dividend payments, and they started recently to do more buybacks. Their number of outstanding shares are down 10% compared to 2018 to 2024, so your EPS is growing faster, of course, with shares down and your cash flow is slowly growing. And this is from their quarterly Q3 numbers, so they are committed to long-term value of our shareholders. What does that mean? So they returned this much so far in 2025, split between dividends and buybacks. So they increased their dividends by 4%. I told you a couple slides ago that from 2018 to 2024, they grew more than 5% annual growth rate on their dividends. This is their 60th increase in the past 56 years. So they have a really solid dividend history, which itself makes them a reliable holder if you have a need for consistent quarterly dividend payments. Of course, they increased their buybacks. As we see, they've been increasing those for the past couple of years. And then their net debt to EBITDA ratio as of September, right? So we'll talk about this part more on the next slide. So where do we put the valuation? If I expect them to continue to grow at like how they've been growing, basically 1%-ish compounded annual growth rate, then with a 10% discounter, I expect the intrinsic value to be around $53. Of course, you cannot really miss with a company like this, which is really low growth, stable, major. So right, so what you can do is that you basically say, what's the 10% return I get for free cash flow? And then you buy that price and you kind of get it. So you can benefit if there for some reason the company sells really off without long-term benefits, and then you can maybe long-term impacts, and then you can buy it and then hold it for long-term. So for example, BAT in 24 February, I believe, they released their annual report for 2023, and they had a huge impairment on their goodwill because they changed accounting. I think it was around 20-something billion pounds. So that was a huge impairment. So if you looked at their income statement, they had a huge loss. The cash flow went up. The cash flow was amazing, but they had an impairment related to basically the brands and all the goodwill, right? Because in 2017 they bought Reynolds, and then they had a huge goodwill. So it was a non-cash item for BAT. The share price went down below $30 per share on the ADR. And then I was looking there and it was like 27, 28, 29, like if you have 26, like what? I'm getting a 20% free cash flow yield on a business that is just slowly growing a couple percent every year and pays out. That's amazing. So that was a good opportunity for BAT at the time. So that's a classic example of a company where something happens to them that is not detrimental to the long term, but has a short-term negative effect, at least on the image of the company. Okay, so the company itself is highly profitable. So if you look at the return on tangible assets, it's about 50%. So this is basically return on investment is the same as return on tangible assets, but you, instead of all assets, you only look at tangible assets. So this is crucial for a company like this, because you cannot calculate return on equity because this company has a negative equity. And people would look at like, what's their debt to equity? No, they don't have equity. They have negative equity, which is not an issue for a business like this, which has brands and goodwill. Coca-Cola, for Coca-Cola also, return on tangible assets makes much more sense than return on equity. They are making lots of money with not much tangible assets. So this is a great business. Right here you see that their free cash flow relative to the cash flow from operations is 98%. What that means is that They barely have to spend anything on maintaining their physical operations. These are amazing businesses. Of course, they're like, of course, they still have a lot of debt, right? And then can they pay back their debt? So their cost of debt is relatively low. Of course, a bit higher in 24. We had rates higher than on the 7-year average, and then they can easily cover. So they have more than 10 times interest coverage, which is of course good enough for, especially for a stable business like this. And then you can see in their current ratio that they are not holding that much cash on current assets versus current liabilities, half as much current assets than current liabilities. Why is that? Well, because this is a stable company, you have moving cash. You can pay down your liabilities when they occur. Probably they delayed paying down their vendors for 1 or 2 or 3 months even, because they have that much leverage over their distribution and their vendors because of their size and stability. They can park cash in the money markets, or they can just like delay paying them, so they don't have to hold as much cash. This is only also a sign of a relatively of a stable business, right? An oil company or a gold miner company couldn't get away with negative equity and such a low current ratio. So the debt is easily manageable and it's highly profitable company. So currently the dividend yield forward looking sits around 7.4%. And if you look at 2024's free cash flow, you have a free cash flow yield on today market cap around 9%. Long term, they have regulatory pressures, although that might actually help them, as we saw with the Trump administration crackdown on illicit products. Of course, they have declining volumes. They have to offset that with increased prices. And how long can they do that? And shifting consumer habits. So this two ties together. And can they cash in on the new types of product? Although I would like to mention that in the past couple of months, especially, or year, you have this sort of a resurgence of nicotine being recognized as not like nicotine being having health benefits around let's say testosterone studies, which are from NIH from I think the 90s. So it's not the new stuff, but it's being less bad in the public's eye. Of course, smoking is really bad because it has a lot of stuff in it that's not nicotine in itself. But you just see this. You see these Tucker Carlson shows on the advertisement. They are talking, and on the show they are talking positively about cigarettes smoking. So maybe the shift in consumer habits the pendulum's gonna swing back a bit. Overall, it's a tobacco leader in the US with the Marlboro, huge cash, huge prices, sin stocks, so institutions are not going to touch it, so the company's valuation is going to be lower. Business is likely to be stable, low growth, which is great. The moat is wide from brand power, and of course regulation and regulatory barriers and scale. I think smoking rate decline could hurt the business long term if they cannot adjust, but maybe that's over. Maybe it's not gonna decline as much. Maybe they can offset it with price increases. Maybe they can offer new products. Experienced leadership, of course, dividend, 56 years of dividend history of consistent. So over 50, they have an 80% payout ratio. They have a misstep with Juul, right? But they tried to do something. Then they did it with Enjoy. We'll see how that works out. So far, they make money from tobacco products, smoked and non-smoke. So, but the management is focused on shareholders and returns. So on the valuation side, it's fairly valued, right? I always look for a 10% hurdle to have a 10% return. They are 9% returning on free cash flow with a nice dividend. Strong, I would say, balance sheet, but they have negative equity, so they can easily cover the interest cost and debt cost. I would put Altria here. I don't see much upside. It's kind of actually a bit too pricey for me, given they are not giving even 10% return. Although if you put it in the US context, US companies tend to be more they tend to carry a premium. So if you compare Imperial brands or BAT on this list, they are non-US, so they are cheaper than Altria This is generally true to every company. Non-US is usually more expensive than a non-US is cheaper usually than a US, even if every number is the same. So if you enjoyed this video, please like and subscribe and let me know in the comments. If you have any stock ideas you want me to look at, also let me know. Take care, have a nice day, cheers.